Hey everyone, Cameron Lombardi back with another stock market investing video. Today I'm going to be taking you through how to sell cash secured puts and covered calls on Robinhood and show some examples that I currently have. Before I get into the video, if you guys want to hit the like button to show some support for the channel, I'd greatly appreciate it. And if you want to learn more about how to generate passive income using options, definitely subscribe to the channel. I post videos pretty frequently showing the strategies that I use. And if you want to get started investing in the stock market, use the first link in the description to download Robinhood. Robinhood is completely free to use and trade on, and it's very user-friendly. By using that link below, you'll get a free stock to get yourself started. All right, so let's get into the video here, guys. The first thing I want to show you all is how to sell a cash secured put. So what does selling a put mean? So when you sell a put option, it's essentially an agreement you are making to buy shares of a company at a specified price that you choose and with an expiration date that you choose as well. And for doing so, you get paid a premium, which is basically just cash into your account. The strategy is really good if you were thinking about buying a stock, but you don't want to buy it at its current price and instead want to buy it at a price that's below where it's currently trading at. So let's take a look at Google, for example. Google is currently trading at $124.82 a share. But let's say you'd be more comfortable buying Google at somewhere around $120 a share. So what we would do is go into trade options. We'll pick an expiration date up at the top, so June 23rd. And at the top, we'll click sell put, which is already selected there. And then these are the put options that we have on Google for next week. And as you can see, as we get further away from the current price of the stock, that number on the right side there in the little bubble, which is the premium that you get paid, decreases because as we get further away from its current price, there's less of a chance that the stock will actually drop down below that price. And remember, when you sell the put, it's essentially an agreement to buy the 100 shares of a stock at the strike price that you choose. So you can see here where it says chance of profit in the middle of the screen. As we get further away from the share price, that chance of profit increases, which means the stock is less likely to drop to that price at the time period that we have here. Now, if we go a little bit further out, if we go to June 30th, you can see that the premium prices increase. So that means you'll get paid more because the stock price has more time to move in either direction, and the chance of profit decreases slightly because there's more time for the stock to move down. So let's just say we wanted to buy Google here at $120 a share, and we went 2 weeks out from right now because tomorrow is going to be June 16th. So we would go 2 weeks out to June 30th here, and you would click on this $120 put. And on that number on the right there it says 78 cents, but you times that by 100 because each options contract is executed at 100 shares. So we would click on the $120 strike price. We would hit sell one, and then you would choose your price here. The price is a little bit weird right now. It says between 78 cents and 97 cents per share. That's because we're after hours here. It's typically $1 or $2 in the spread there. So you would choose the price that you want to sell it at. And if we did 0.78, you can see it's times 100 shares. So you get paid $78 to sell one put on Google at the $120 strike price for the expiration date of 6/30. So now let's talk about a trade that I just ended today on Google. If we scroll down here to my history, you can see I sold a $120 put on Google for expiration date of this Friday, and I got paid $85 to do so. And today I just bought it back for $5, which means I paid $5 out of that $85 that I made to buy it back and exit out of the position. Why did I do this? Because it only has one more day left. It only has $5 more to make on the trade, which is pretty much all of the profit. So I went ahead and bought this back today. If Google stock price drops tomorrow, I can go ahead and sell another put on Google and continue to collect this premium again, week after week, every other week or month, whichever strike price and date you want to choose. It's totally up to you. An important thing to note that this should only be done on stocks that you actually want to own. Selling puts means you are obligated to buy the stock if it does drop below the price that you choose. So you only want to do this on good quality companies that you want to own. Now, what happens if you do get assigned the shares? You get assigned 100 shares. Now what do you do? So now we're going to talk about selling covered calls. So when you sell a covered call, you're entering into an agreement to sell 100 shares of a company that you own at a specific price that you choose and on a specific date that you choose. You'll get paid a premium to do so, just like you do when you sell a cash secured put. So if you notice, it's very similar to selling a put, except this time you're actually agreeing to sell the shares that you own instead of agreeing to buy shares of a stock that you don't currently own. Selling a put is an agreement to buy 100 shares, and selling a call is an agreement to sell 100 shares of a stock. So let's take a look here at the covered call options if we did 100 shares of Google. So what you would do is hit trade options. We would choose an expiration date. Again, we'll go to June 23rd, and this time we're going to go to sell call at the top of the screen. And here we can see all of the different call options that Google has. So let's say we owned Google right now at $124 a share. If we wanted to sell a covered call for next week at the $128 a share, that means you'd get paid 87 cents per share or $87 for 100 shares. So if you owned Google at $124 a share and you agreed to sell this $128 covered call, if Google did go above that $128 at the end of next Friday, you would then sell your 100 shares at a $400 profit plus the premium that you get for selling this option. So let's say we sold it for $87, your total gain would be $487. If the stock price does not go above that $128 per share, you just keep the premium that you made there, that $87. You also keep your shares, and you can just keep doing this week after week on any stock that you own 100 shares of. So one example that I have of a trade like this is on Bank of America. I'm currently selling a covered call on Bank of America at a $30 strike price. It expires tomorrow on June 16th, and I got paid $15 to sell this covered call. And as you can see, it is currently worth $3. So if I wanted to, I could buy this option back and then go ahead and sell another covered call on Bank of America, and I'd still walk away with that $12 profit that you see at the bottom there. Or I just let this ride out and expire tomorrow, and it's likely that this will not go above the $30 per share strike price that I sold, because Bank of America doesn't really move too much day to day or week to week. I think Bank of America is a nice, easy stock to learn how to do this strategy, and it's currently sitting at a nice price as opposed to its usual value, which is in the mid 30s here. So effectively selling covered calls and selling cash secured puts is what's known as the wheel strategy. You start this strategy by selling put options until you get assigned 100 shares, and then you flip right around to selling covered calls. Each time you sell an option, you earn a premium, and you can make money whether the stock moves up, down, or sideways. I can't stress enough how important it is that you only do the strategy on stocks that you actually want to own and wouldn't mind holding on to. If the stock price drops, you could end up holding these shares for a little while until it recovers, so be sure you're picking good quality companies with this strategy. When done correctly, this can be a great strategy to build your portfolio over time and eventually generate yourself a nice income stream. So as we can see here, guys, I do have a decent amount of buying power that I need to use up. I did have a couple cash secured puts going on Amazon and Google that I just bought back. So I will be making some more trades here very soon, and I will keep you guys updated on those trades in the next couple videos. I hope you all found this video helpful and learned something from it. This is what this channel is all about, is helping people learn and so we can grow together. So definitely be sure to subscribe and follow along to see more videos coming in the future. If you guys enjoyed this video and want more content like this, definitely leave a thumbs up below to let me know. Thank you all so much for watching, and I'll see you in the next one.